This is the countdown to the close. Romaine Bostick here alongside Scarlet and Katie Greifeld, coming off of a big Fed meeting where the decision where interest rates would lie remained exactly where we thought they would be. But the big surprise today was the dot plot, the projection of economic conditions, the projection of where the Fed's funds rate might go. And those projections now are to the downside. If you go back, Scarlet and Katie, to that September FOMC meeting when we last got the dot plot, we were talking about a Fed that was still talking about more rate hikes this year and, of course, holding rates higher into 2024 and into 2025. The dot plots we got today is a complete reversal of that.
A complete reversal. And what was interesting, I think, what you're seeing in the market reaction right now is the fact that in the dot plot and then in the press conference, there wasn't this pushback from Jerome Powell against what the market is pricing. If anything, the fact that he didn't push back at all was taken as an endorsement of these rate cuts.
Yeah, it's a complete tonal shift from what we've heard in the past. What I thought was really interesting, and this might get a little bit nuanced here, is he reiterated the Fed's dual mandate of maximum employment and price stability. He says those two jobs are equal, except they haven't been, right? No. Price stability has been the priority the last couple of months. At what point does employment take over?
Absolutely, and I'm glad you bring that up because I missed that comment, and it seems to contradict comments that he's made publicly just this year alone. So, but he is the Fed chair, so I guess he can say whatever he wants here. But this is a big question right now when we talk about that dot plot that you're looking at there. What you're looking at is a Fed. The Fed is telling you at least 3 quarter-point rate cuts are in the cards for 2024. Remember, coming into this meeting, the market was pricing in just a little bit more than 4 rate cuts. So this is more the Fed trying to meet that market. But a big question here is when it will actually be appropriate here for the Fed to start moving in that direction. Let's take a listen to what Jay Powell had to say a little bit earlier.
And a question of when will it become appropriate to begin dialing back the amount of policy restraint in place that begins to come into view. And is clearly a topic of discussion out in the world and also a discussion for us at our meeting today.
Jay Powell speaking just a few minutes ago. Joining us right now on the close is Betsy Duke, former Fed governor, former chairman of Wells Fargo, and a long, long career in the community banking space. And Betsy, you heard the chairman there, and you saw the dot plots here. I'm wondering if at all this backs them into a bit of a corner should they find that they need to pivot.
I don't think it backs him into a corner, and I think he was very careful to condition everything where he would say, you know, we see this happening, but we see this happening, but. I think what I got out of the dot plots is that all of the participants now seem fairly confident that another rate increase is not going to be needed. And if you look at the starting point and think of the dot plots as a projection as of a point in time. So the last projections were done in September before inflation had come down quite a bit as it has since then. And so now the starting point is where the inflation readings are coming now. And the trajectory from there looks about the same as the trajectory from there in the previous plots. So I think unlikely that rates will go back up. Yeah. Likely that there will be cuts in the Fed funds rate. But I only got 2 to 3 cuts out of the dot plots when I looked at them.
Yeah, and that raises the question, though, exactly how you get to a stage where they do feel comfortable cutting. And when I say cutting, I mean really starting an actual loosening cycle, not just cutting by one and then letting it sit for a few meetings.
Well, I think Chairman Powell was very careful to say these plots are a projection as of a point in time. They're not, and they're individual projections. These are not a group plan. This isn't something they discussed and said, this is what we're likely to do. Each of them said, this is what I think is going to happen to inflation over the next couple of years. And this is, given my estimate of where inflation is going, this is where I think policy should be.
Betsy, there was little doubt, no doubt, in fact, that the Fed would hold rates. The question only was, would it be a hawkish hold, a neutral hold, or a dovish hold? And the answer was, it was a pretty dovish hold, or at least that's how markets interpreted it. Was that leaning, do you think, determined more by the current economic data or the market's positioning?
Probably a little bit of both. And I think the market really reacted to the difference between September's projections and December's projections. But the data changed pretty significantly between September and December. And since you don't get an update of these except every other meeting, the more time that passes and the more data that comes in since the last projections, the more stale they get.
Yeah, and that's exactly what he told us last time, too, that they're good for about a month and then they've expired. When it comes to financial conditions, then, would you describe them as tight or loose? Because they've loosened considerably since the November 1st FOMC, but are clearly much tighter than the start of 2022. Is there a sweet spot when it comes to financial conditions for the Fed?
I think the Fed's trying to avoid having the markets take some hint and then run like crazy with it. Markets tend to go all the way to the end of what they expect you to do, and I think markets are expecting more cuts from the Fed than the Fed at least is saying right now it expects. The committee.
Let's talk about what's going on in the market right now, because like Scarlet said, this is being taken as a pretty dovish meeting. You take a look at two-year yields right now down, 28 basis points. You take a look at stocks off to the races, the Dow at a record high. Was it that dovish? Does this market reaction make sense?
It seems a little extreme to me, based on what I heard. And I think you have to be very careful, particularly with Jay Powell as the chairman, of taking an indication from something he didn't say and running with it, because Jay's perfectly capable of saying exactly what he wants to say.
And Betsy, of course, Powell also said that the Fed did discuss the timing of rate cuts at the meeting today. And it seems like you take a look at current pricing that a cut in March seems more likely than not. Would you say that sounds about right, or what are you thinking around timing?
I would be surprised if that was a discussion that was had as far as timing. My guess is that as they went around the table, and you have one go around for the economy and one go around for monetary policy, and I think everybody at the table discussed exactly what they wrote down, which is, this is what I see happening. And I don't think it got as fine-tuned as March versus June, and I think that's all going to be dependent on how. So does inflation still drop sort of in a straight line from here?
Yeah. Or
Or do you see some sort of stagnation in where inflation, particularly core inflation readings are now, and we have a hold, and it's a much longer journey from 3 down to 2?
All right, Betsy, always wonderful to get your insights. Former Fed Governor Betsy Duke there, helping to break down what we just learned out of Jay Powell and the Fed here. And of course, we talk about a dovish report and really the dovish sentiment we saw in the market. You mentioned 28 basis point drop on a 2-year yield, Galen.
Yeah, it is pretty amazing, I would say, to watch that.
All right, we're going to break down all of the market moves in just a second. Stick with us. Full market coverage coming up right now as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlet and Katie Greifeld. We're counting you down to the closing bell. And here to help take us beyond the bell. It's a global simulcast with Tim Stenovic and Mike Regan. Welcome to our audiences in full on this Fed day here. A day where the Fed did not give any real change in their policy position, but they certainly gave us a big shift here in their outlook.
Yeah, it's certainly a day when the market said the Fed has officially, or I think the market has officially declared that the war on inflation has come to an end. Rate hikes have come to an end. And the Fed, Mike, is going to start easing. I mean, look at the rally we're seeing, not just the decline in bond yields, but also what we're seeing in the equity market right now. I mean, this is a historic day.
Yeah, absolutely. And I keep thinking about what we just heard from our guest, Sarah Ponzek of UBS, saying, if everyone's excited about rate cuts, it makes you wonder what will cause, what in the economy will actually cause that to happen with the Fed. So it is a great day. It's a celebratory day. We've got the NASDAQ 100. I love round numbers, Scarlett. NASDAQ 100 up more than 40% on the year today, as of today. And really, it's not so much a rotation. It's every index is up more than 1%. So people are just buying everything at once with both hands.
Yeah, the everything rally just got another kick up in gear. And of course, the Russell 2000 up 3.5% right now. I believe this might just be the beginning of the January effect.
Okay, how about the Dow Jones, though? I mean, we're talking about small caps. Let's also talk about the Dow Jones as well, hitting a record high, just like you said, everything rally. Amazing moves, particularly in the bond market.
Yeah, the Dow right now looks like it's going to close at a record high. Remember, that's on the back of what is already really about a 12% rally since the end of October. You're hearing the bells here in New York, and let's walk through the numbers as we wait for the numbers to settle. But it's going to be green across the screen with the Dow up more than 500 points, or about 1.4%. The S&P 500 cracking above that 4,700 level, its highest level going back to mid-January 2022. And if you just do the math, you're now less than 100 points away from reclaiming that record high. That means it only needs a move of less than 2% in order to get there, a 1.4% move here on the day. The NASDAQ composite up about 200 points, or 1.4%. And the Russell 2000, that was your outperformer here on the day, a 3.5% gain on the Russell that now has it flirting with 2,000.
Yeah, look at that. Broad-based. We're seeing a lot of green on the screen. And I got to tell you, if you peel back the layers of the S&P 500, hard to find decliners in there. Scarlet, 458 stocks moving to the upside today. Only 44 stocks moved lower. On the Dow, it's 27 stocks moved higher and 3 declined.
Well, okay, that's Mike Regan's job to look for some decliners. But in the meantime, let's look at the sector performers here. You have 24 industry groups, 22 of them finishing higher. Utilities, real estate investment trusts, and banks leading the way, each up by more than 2.5%. And the only sectors to fall are telecom services and insurers.
All right,
Actually,
well,
and before we move on, too, I just had to double check this here. The NASDAQ 100 also at a record high on the day.
Okay, look at that. Well, speaking of record highs, we got Apple closing at a record high this afternoon. That's my first gainer, finishing the day up by more than 1.6%, 197.96. It has been higher intraday back in July, but this is a record high for closing. It closed a previous all-time high was 196.58 back in July. Finishing the day higher right now by 1.7%, up another $3 today. Stock up more than 50% so far this year. Also got to look at the best performing stock in the S&P 500 today, Vertex Pharmaceuticals. This company absolutely surging on the day today as a result of the company saying its non-addictive drug helped patients with chronic nerve pain from diabetes. Up more than 13.2%, closing and rallying to a record high. This drug was generally well tolerated at all doses, and Vertex is planning to actually move the drug into the final phase of human testing. And finally, we're back to, prices might be coming down a little bit, or the rate of increases prices might be coming down a little bit, but we could see more expensive eggs out there. Let's check out Cal-Maine Foods. COMUS is the ticker symbol. The nation's largest fresh shell egg producer and marketer,
just
rose the
spit it out,
most
Tim.
intraday. What's that?
Just spit it out, because I'm fascinated by this story.
10.3%.
This broke yesterday after the close.
Yeah.
And the shares plummeted because everyone said, oh, avian flu, that's bad. But then everyone woke up and realized, well, if you're taking 600,000 chickens out of production here, that means prices are going to go up. So a net positive. How does that work?
Well, that's supply and demand, my friend. It's the basics, right?
Can I ask one question? What is a fresh shell egg? What is the distinction there?
I'm guessing it's an egg that's not already been cracked.
Okay, very
Right?
good. Thank you.
That
Is that
should be
right?
what we're all
I'm
aiming
guessing.
to purchase, no?
I mean, you have to make
Well,
these
how much are the
distinctions.
cracked eggs? Because I don't think I can afford a fresh shell.
So I hope we don't see a return to these high egg prices. But Romaine, you did talk about the news that we saw yesterday. The company coming out and saying that it has to close one of its Kansas facilities after it tested positive for the avian influenza. One analyst wrote that the virus has started to ramp back up across the U.S. Cal-Maine Foods up by 10.3% today.
Well, I did find a few decliners for you, Tim. Not many, or downers, as I like to call them. But big drop for Pfizer. Down about 6.7%. That's the most since June 2020. It was actually down as much as 10% at one point, which would have been the worst drop since 2009. But Pfizer lowered their full-year revenue forecast to a range of $58.5 billion to $61.5 billion, so well below the $62.9 billion that analysts were expecting. It turns out that the sales of the COVID vaccine, not a bright outlook for those, as well as there was hope that their takeover of Seagen, the big cancer drug maker, would help their forecast, but not enough to counteract that drag from lower vaccine sales. So big drop for Pfizer. Also, Southwest Airlines down 3.8%. They actually did slightly raise the low end of their fourth quarter revenue forecast, but not the high end, and investors were hoping for more after JetBlue Blue's forecast last week really raised sales and profit expectations for the quarter and the full year. So a bit of disappointment from Southwest here. And finally, Etsy down about 2.3%. They were down almost 9%. So this rally in the market is sort of cutting the losses in some of the stocks that were down. Etsy came out and said they would cut about 11% of its marketplace workforce. Now, sometimes job cuts can boost a stock, but not this time. Etsy down about 2.5% on that news.
All right, let's get to the bond market because that's really where a lot of the action is today. You look outside the equity market and you take a look at two-year Treasury yields right now. Just a fantastic plunge on the two-year, down about 30 basis points. That is the biggest move since March, of course, when we had that little bit of a banking meltdown. A lot of that is more cuts getting priced in to 2024. That's really where all the drama is. But then you take a look out of the curve and you also see a lot of double-digit, I don't know if you can call that if we're talking about basis points, but the point being pretty big moves as well. You take a look at the 2s-10s curve continuing to march towards positive territory, but still about negative 42 basis points inverted with that two-year yield leading the plunge lower.
Yeah, and of course, the Fed really driving this market right now. Of course, there are still some idiosyncratic stories out there, particularly when it comes to earnings. And we are getting earnings crossing the wire right now. This on the software company Adobe. Shares moving lower here in after hours trading after the company said that in its most recent fiscal quarter, EPS came in well above estimates, but revenue came in line. $5.1 billion in revenue in the most recent quarter, $4.27 on EPS. But here's your guidance going forward. The full year 2024 guidance, EPS expected to be in a range of $17.60 to $18 a share. The street was looking for $18 a share on average, and revenue for the full year. Actually, I don't have the full year revenue forecast before the current quarter, the current fiscal quarter here. They're looking at revenue of 5.1 to 5.15 billion. That high end of that estimate is slightly below the average of street estimates.
Yeah, I go to the press releases. We continue to see Adobe move lower, down by 7.6% in the aftermarket. Dan Durn, Executive Vice President and CFO, saying that the company's performance in the fiscal year 23 drove world-class margins and operating cash flows of $7.3 billion. He calls out the scale, the speed of execution, and profitability position that the company for years of sustained success. But investors in the after hours certainly not buying this.
Just wanted to point out that the full year revenue forecast came out $21.3 billion to $21.5. Analysts were looking for $21.74 billion. But notable that these forecasts don't include Figma, which of course is still pending that purchase as the EU and the UK oppose that acquisition.
All right. Well, reminder that we're still in earnings season, even though we're close to wrapping up the final quarter of the year, guys. That is going to do it for Beyond the Bell, our cross-platform coverage of the market close right here on Bloomberg TV, on radio, Bloomberg Originals, and YouTube. Meantime, catch us tomorrow, same time, same place. Happy Fed Day, everyone.
All right, stick with us here on Bloomberg Television, a deeper dive into what we learned out of the Fed today and a deeper dive into the market reaction to it. The market reaction was severe. Ken Shinoda, portfolio manager over at DoubleLine Capital. He knows it better than anyone. He's joining us after the break right here on The Close. This is Bloomberg. All right, a big day for the Fed. No change in rates. That was expected, but a big change in the Fed's outlook going forward. Now, at least the projection based on that dot plots, now the Fed saying that they could potentially cut rates as many as 3 times in 2024. Of course, the market was already running ahead of that, but the validation they got today really sent us off to the races in the equity markets and in the Treasury space, too. Ken Shinoda, DoubleLine Capital portfolio manager, joining us right now to talk a little bit more about that. And let's start off with the Treasury rally, because this is phenomenal here. A 2-year yield now down 31 basis points on the day. And if you exclude that 60 basis point drop we had during the SVB crisis, you got to go back a lot of years before you find a day like today.
Yeah, it's quite a rally, and it's I think wasn't necessarily expected. I think the market thought that the Fed would be, stay on hold, maybe be a little bit hawkish in Powell's conference afterwards, but have a somewhat of a dovish tilt, and it ended up having a way more dovish feel to the meeting, moving the SCP dot plots down to 3 cuts, as you suggested. And I think declaring somewhat of a victory lap, because inflation is moving down towards their target. Growth data has continued to slow. And I think one of the interesting things that Powell said towards the end of his conference, that the risks are maybe not cutting soon enough, which was very different from their higher for longer mantra that they had stuck to from much of the last 2 years.
Yeah, and we should point out, too, that also in those dot plots, they did have their core PCE projections, those coming down to 2.4% next year and back down to 2 within a year and a half's time. I am curious, Ken, here about market positioning, particularly as you see credit spreads tightening today, you see the big drop in yields here, but you still have a lot of people kind of crowded into the same trades. And I'm wondering if you anticipate you'll see a bit more broadening out in duration and a bit more broadening out in risk.
Look, I think we've had a ferocious rally from the dark days of October when it seemed like there was no good news coming out for bonds. And so you've seen over 100 basis point rally in the 10-year, and that has lifted the equity market as well. So I wouldn't be surprised to see a little bit of a pullback going into year end. I think on the fixed income side, maybe that gives investors an opportunity to add to duration, because I'm sure many are sitting there saying, hey, I missed it. I missed that 5%. But we got to remember the 10-year was at 330 not so long ago at the beginning of this year. So the market has room to run if you continue to see inflation come down, and especially if growth continues to slow.
Let's meditate on duration a little bit longer here, because, of course, one of the stories of markets in 2023 is just this fantastic bid into cash. You take a look at nearly $6 trillion sitting in money market funds right now. Are we finally going to start to see that rotate out?
You know, as a bond manager, I sure hope so. It's our number one competitor over the last couple of years has been the T-bill and chill mantra. But I think the Fed is basically telling you got to start moving out the curve. And if you don't want to take on too much duration, just start going out 2 years, maybe go out 5 years. There's plenty of places in the fixed income market that provide a lot of value. So I think it is time for investors to start coming out of cash and locking in some of these yields. I know the market's moved from the highs we saw in October, but it's still very high historical levels and attractive relative to long-run equity returns.
Okay, so T-bill and chill, maybe that's over. Maybe it's time to take on some duration, at least going out to 2 years. Let's talk a little bit more about credit risk right now, because I'm looking at IG spreads. I'm taking a look at junk spreads as well, and just the tightening that we've seen this year, and especially in the last month or so, has been pretty interesting to watch. Is there enough risk priced into these markets right now?
Look, I think the investment grade market is a pretty safe market. The quality of that market has improved through time. Even high yield has improved as a basket, as much of the lower credit quality borrowers moved into the bank loan market last year. So spreads are tight. I think it's a security selector or bond pickers market. You can find opportunities out there. But broadly speaking, if you go into a slowdown, you would expect some spread widening. Now, the all-in yields can offset some of the risks associated with spread widening. And I think that some of those parts of the market could outperform equities into a growth slowing, earnings slowing type environment. But some of the stuff that's lagged, some of the more kind of non-index type assets, non-government guaranteed commercial mortgage-backed securities, asset-backed securities, things like that, have not really enjoyed the same rally as the corporate credit markets. And I think if we don't see any speed bumps from here through maybe the first quarter of next year, you're going to see a catch up in some of those markets. And that's some interesting relative value for investors out there.
So if there is going to be a catch-up, I want to go back to the point about how there is a lot of potential across the fixed income curve, across the product lines for investors to look at. You no longer have to hide out in T-bills. How much cash is there sitting on the sidelines waiting to be deployed, and what would that deployment look like, do you think?
Yeah, well, there's over $7 trillion, and it's actually been going up over the last couple of weeks for whatever reason, in money markets and T-bills. But I don't think all of it comes back. You know, in 08, 09, after the GFC, the Fed took rates to zero. So I kind of had to move out the curve. But if the Fed cuts, let's say, 100, 150 basis points over the next year or so, I know only 100 is priced in, but they usually don't just go a little bit. They usually go a lot. I expect some of that money to come out. But let's just say Fed funds and T-bills go from 5.5% to 4%. That's still pretty good for a lot of investors. So I think there'll be some movement, but we'll still see a lot of money stay in those short-term type investments, given how high yields would be, even after they cut from the levels they are at today.
Okay, good point. If Powell is making investors more bullish on bonds, I assume he's also making investors more bullish on equities. What would that mean then for bonds?
Well, I think lower bond yields are bullish for equities to a point. At some point in time, if rates keep falling, they're falling because the market's sniffing out a recession, and that would then not be good for equities. So be careful what you wish for as far as rates being lower. I know a lot of people invest in tech stocks, which rates would go back to zero, so tech could go to infinity and beyond. But at some point in time, lower rates means that there's some problems out there. So there's a fine balance to the soft landing mantra that's out there, to the extent rates kind of stay where they are, growth and inflation come down a little bit, but not too much. And equities have gone up a lot. So I like kind of the equal weighted approach versus buying the high flyers, but I'm a bond investor and we're perpetually negative on high flying stocks because bonds only go to par and stocks go to, you name it.
Well, it does seem like some people are kind of starting to embrace that line of thought, Ken, particularly given that even prior to today and the big dovish tilt, you hadn't really seen credit spreads blow out. And maybe that gave some confidence in people to go back in some of those Russell stocks and those S&P 400 mid-cap stocks with the idea that that big refinancing cliff that we're also worried about maybe might not be as onerous when it does actually appear.
Well, look, lower rates is really helpful for some of the parts of the market that got pressured by the refi risk. Commercial real estate is a prime example because a lot of people expected defaults to pick up in the bank loan market, but I think companies have hung on thanks to the flood of capital available to them in the private credit markets. There's about $1.6 trillion in private credit to be deployed and help the corporate markets. But the commercial real estate markets, those borrowers are resetting their rates and they're defaulting because they can't refi into this marketplace. So lower rates is going to really help the commercial real estate market. We've come down a little bit. We need some more to go. But that's one market where maybe you can look for opportunities in the sense that it's not as bad as people expect if we see lower rates for borrowers to refinance into.
Well, Ken, just quickly there, that's kind of what I've been wondering. When it comes to the commercial real estate market, you said that there's clearly some opportunity there. Is it fair to say that the troubles and some of the worst case scenarios that we were thinking about earlier in the spring are firmly in the rear view here?
I think there's definitely problems out there. Commercial real estate and real estate in general, it's location, location, location. And for lenders, it's borrower, borrower, borrower. It all depends what property, who the borrower is, what geography it's located in. So if you can roll up your sleeves and do the work, it's a great time to be a lender right now. You can pick and choose assets. You can pick and choose borrowers. I think it's a better time to be a debt investor than an equity investor. There's just so much uncertainty in buying the equity of properties. And are you going to be able to get financing? Are you going to be able to increase your rent roll? Are people going to ever use office space again? But if you're a lender, you can lend at what you think are reasonable valuations on the property at very attractive risk levels, meaning lend at low loan to values. And you get pretty interesting spreads. And with SOFR up and short-term rates up a lot, just like all the private credit players talk about how great private lending loans are, that's the same thing that commercial real estate loans offer today.
All right, Ken. Well said, as always. Always appreciate you taking time for us. Ken Shinoda, portfolio manager over at DoubleLine Capital out there on the West Coast. Stick with us here on the program. We're going to dive a little bit deeper into the macro and the Fed's policy decisions, but we do have to turn our attention back to earnings. Adobe out with its earnings just a few minutes ago. We'll break down those results after the break. This is Bloomberg.
Hard to believe, but earnings season is not over yet because Adobe just reported a few minutes ago. And again, the stock is trading lower in after-hours trading after the full-year forecast, especially on the revenue side, came in weaker than expected. So let's bring in Anurag Rana, Bloomberg Intelligence Senior Technology Analyst. And Anurag, when it comes to revenue for the full year, Adobe is giving numbers that don't meet the average analyst estimate. What part of the business is not measuring up to what investors were expecting?
I would say just mildly disappointing. It's only 1 percentage point or 2 percentage point less. And that's in the digital media business. It's also in the digital experience business. But frankly speaking, Adobe has a history of starting the year low and then, I would say ramping up as the year goes along. So I'm not that surprised with it. Also remember the stock's up over 80% this year. So, it's giving us a little bit of that back at this point.
Okay. And also it perhaps it's just being conservative in terms of giving guidance overall. There was a new number that it gave everyone, which is digital media net new annualized recurring revenue, about $1.9 billion. I know this is not a huge amount by any stretch of the imagination, but that was also a little bit lower than expected. Can you talk us through why this is significant?
Yeah, so if you look at it, that's one piece of business that I think the street was expecting to be around $2 billion or so. And I'm fairly confident that by the time a year from now, it will probably cross $2 billion. But what really is happening over there is in this particular business, they have created a new product called Firefly, which is a generative AI product that can create images with using your prompt command and stuff. This is where you will see the most benefit for Adobe in terms of any of the AI initiatives. So I think that's really why that number really is the most important metric at this point for Adobe over the next 12 months.
This gets us to some of the regulatory issues that they're dealing with, particularly when it comes to that acquisition of Figma, an acquisition that I think a lot of people are still wondering if it's ever going to get done.
Yeah, I have said this many times. I mean, I'm in that camp that they should not be doing that acquisitions. They should save that money and perhaps, use it for buybacks and other things. But I think Adobe is already in a very strong position with or without Figma. But it is going to be a tough one to close that one for them. I mean, it's been under scrutiny from a lot of governments, and I think it's going to be a while before that closes, and if that closes.
Yeah, and the European Union seems pretty intent here on trying to block that. I'm also curious here about another regulatory issue that cropped up in the 8K filing from today, and this has to do with the company's subscription practices. It disclosed that it has actually reached out by the FTC back in 2022 and had communications with the FTC as recently as November about settlement talks about violations, I guess, of some provision in the law when it comes to subscriptions. Do you know anything about that?
No, it's the first time I'm hearing it, but I have a feeling that software companies deal with this kind of stuff quite a bit, just because it is a subscription service, and we all know once we subscribe to something, it's not easy to get rid of it.
And Anurag, I want to go back to Firefly right now, because in your preview, your Bloomberg Intelligence preview, you wrote that Adobe Firefly adoption rate, it's likely to dominate the call. Looking through these numbers, taking a look at the share reaction too, is that still your expectation that that's what's going to really occupy the airwaves?
Yeah, I think the analysts will ask them that, we were all assuming, let's say, a $2 billion ARR for the next 12 months. Why is it that you're not going to be able to get to that? And is the Firefly adoption not going up to plan, or is it going to be delayed, or what kind of initial reception are we seeing? I think there's going to be a lot of discussion around Firefly, on the conference call.
And is there anything that we can extrapolate out from these Adobe results when it comes to corporate IT spend demand right now for the rest of the industry?
I think one of the things that we mentioned was, I think beginning of the year, they're going to be very cautious. In fact, I think today's potential interest rate move, does give some benefits to, or some comfort to people that, you may be looking at the, less of a restrictive policy next year. We think corporate spending will rebound next year. I think second half story for a lot of the consulting names, and, the first half story mostly for cloud infrastructure names. So I think, it's going to be good in our view. It's going to rebound. This has been a very bad year for corporate IT spending, but we see the light at the end of this tunnel.
All right, Anurag, always appreciate your instant reaction and analysis. That is Anurag Rana of Bloomberg Intelligence. Now, coming up on the close, we'll be speaking with John Taylor. He is Stanford University Professor of Economics. That conversation coming up next. This is Bloomberg.
All right, well, the U.S. equity rally that a lot of folks thought really didn't have much legs to go got a huge shot in the arm today on the back of that Fed meeting, and more importantly, a dot plot that made it clear here that the next path forward for interest rates is most likely to the downside. That pushed a bid under Treasuries and it pushed a bid under stocks, 47.07 on the S&P 500 on the day, a 1.4% gain, and more importantly, less than 90 points away from reclaiming that all-time high. We should also point out the NASDAQ 100 at one point on the day did actually trade above its all-time high, and the Dow Jones Industrial Average, it closed at its all-time high. While the Russell and some of the other indexes still have a little bit more work to do before they get back to those highs, almost all of them right now are sitting on their best levels that we've seen all year long. Of course, a lot of the action was in the Treasury space, including a dramatic drop in the 2-year yield, down about 31 basis points here. That was the most severe drop that we've seen in yields, basically the strongest rally on a price basis that we've had going back to mid-March. And that was in the wake of the SVB crisis, where everyone thought that the world was collapsing. But Scarlet, based on what we heard today out of the Fed, based on what we saw on the dot plots, is certainly a much rosier picture heading into 2024.
Yeah, a different reason for investors to pile into treasuries. Well, as Romaine illustrated for us, a lot of highs when it comes to equities, some big rallies when it comes to bonds. We know the Federal Reserve held rates steady for a third straight meeting and then gave its clearest signal yet that its aggressive hiking campaign may be finished by forecasting a series of cuts next year. So joining us now is John Taylor, Stanford University economics professor. John, it's good to speak with you. You saw from Romaine the kind of market action we got today. What did you hear from Jay Powell that gave the bond and stock market the green light? And do you think it's justified?
I think it's justified. I think, first of all, he didn't back off on the 2%. Going to 2, he said it a couple of times, which was good. I think there's also the emphasis that was it 5.25 to 5.5 is the place they'll stay for a while, and the rest is we'll see what happens. So I think the market liked that certainty. There was some indication that they'll be doing a little more next year, though.
Yeah, you mentioned he didn't push back on the 2%. He talked about that a number of times, but at the same time, he also said that you wouldn't want to wait for inflation to get to 2% before you started cutting, because it takes a while for policy to make its way into the economy. So as we start to think about rate cuts, how would you think about the cutting cycle that might ensue?
Well, actually, I like the so-called Taylor rule. There's a Taylor rule out there which is pretty close to where the Fed is now. They were behind. Let's not forget, they were behind. There weren't too many questions about that, but they were only 25 basis points when it should have been closer to 5. Now they're pretty much caught up. And I think if you use that as a guide, you'll see they should begin to lower rates as the inflation rate continues to come down and is on a more steady basis. We don't know if it'll bounce up again. We hope it won't. We hope it'll continue down, and that's the key. And I think if the Fed does that, they said some indication of how low the funds rate would go, maybe a little bit too slow by my calculation, but I think it's in the right direction.
It gets to this idea here, though, too, Professor Taylor, when we talk about the trajectory of inflation, at least on core PCE, which is clearly to the downside, but fold in the labor market conditions. And there was a lot of discussion today about how the Fed dropped from its statement, the statement that it had in the last meeting, where it really focused on this idea that you needed a period of below potential growth in the economy combined with a softening of labor market conditions. Was there any significance in that?
So I think to some extent there was too much emphasis that we should not really think about higher potential growth. I mean, it's not the Fed's job so much to get higher potential, but they don't want to discourage that. And I think to some extent that's the missing ingredient we're looking for right now, is to have a higher potential growth rate. And the Fed is part of that. Depends on the speed of which they will reduce rates when they do reduce rates. But I think that's a factor that wasn't really discussed very much today by Jay Powell, but it is a big factor in the calculations.
How much control do they have in that? Does the Fed typically have in that space?
Well, it's really both fiscal and monetary and regulatory policy. They're all together. But the Fed has a big responsibility to try to keep real GDP equal to the potential and keep unemployment from getting too high or too low. That's the second goal that
rule,
Powell mentioned. But I think that's the important thing to keep in mind. Yeah.
I'd love to bring the balance sheet into this conversation because, of course, okay, it seems like consensus is that the Fed is going to cut and maybe cut substantially next year. But at the same time, we heard from Powell that we're not talking about altering the pace of quantitative tightening right now. Do you worry at all that the Fed is going to be working at cross purposes, potentially, of course, cutting rates, but at the same time tightening by still rolling off the balance sheet?
You know, I really don't think so. I think the quantitative tightening and easing has had less effect than people want to think about. And so reducing the size of the balance sheet, along with some tightening as it occurs, seems to me it makes sense. But I think the lesson that's to be learned, other central banks have to learn this too. There wasn't much of a discussion of other central banks. Is quantitative side is really not the main story. The main story is the federal funds rate, how that affects other interest rates, how that affects the market.
So the federal funds rate, still the primary tool, still the thing to focus on. But to talk about the balance sheet a little bit more, some interesting comments from JP Morgan Asset Management's Bob Michael earlier today. He made the point that you take a look at the size of the balance sheet, it's well above anything that the Fed would like to see. Do you think that that's something that's on their mind right now, trying to return the size of the balance sheet to a general area or size?
I do think so. I think that's part of their mission, is to reduce the size of the balance sheet. They don't want it to get in the way of their interest rate decisions, that's for sure. And I think there's been a big change in the focus more towards the interest rate, towards the federal funds rate, and the impact on other interest rates. But actually, I think this, when you say quantitative easing, it reminds me of how much this is a global story. And the Fed is really in the lead at this point compared to the ECB and the Bank of Japan and other of the big central banks. But maybe more of that should be appropriate going forward.
Yeah, that brings me to the next question. There's a lot of central bank meetings coming up this week. How does what Jay Powell said, and in some cases didn't say, influence how those other central banks roll out their policy?
I think that the Jay Powell has been pretty firm. No change in 2%. We could possibly raise rates. He even said that's a possibility. But the mission, and I think you'll see this in the voting, is it's probably likely to come down as the inflation rate comes down. And that's an important message. Remember, they were just 25 basis points not too long ago, which really was one of the reasons why so many other central banks were not more aggressive. Now they're becoming somewhat more aggressive. European Central Bank, as well as the Bank of Japan, are beginning to move. But I think that signal is an important one to convey. It could have been different, and Jay Powell decided not to make it different, make it into the notion that there may be some more to do.
I am curious then, when you look a little bit further out, particularly as you get into 2025, and I know it gets dicey to kind of make predictions that far out, but you're still talking about a funds rate that they see, at least based on the dot plot, at 3.6%. And you have a lot of market hopefuls who think somehow we're going to return to the days of near zero bound. And with the caveat, Powell has made it clear we're not going anywhere near that anytime soon. But when you look at 3.6%, does that then become kind of that neutral rate that does provide, I guess, enough economic growth without stimulating inflation? And more importantly, can the market live with that?
No, I think if anything, I was concerned that it was a little bit slow coming down, because if you do hope the inflation rate continues to come down, it was 9.1%. It's now, threes or so. Get it down to 2%. And I think is very important. When they do that, it should be, that's the normal rate. 2% is their target. That's a nice goal to strive for. And also globally, as many other central banks have chosen 2%, following the Fed, not exactly following, but pretty close. And so that becomes a world situation, which I think is a healthier world to be in. There's less exchange rate volatility, less other market volatility, but there's a more focus on the monetary policy in the different countries.
What timeline do you think that return to neutral will play out? How long will that take? Do you think that the Fed will be in any sort of rush here?
I think that they will follow, I'm sorry to say this, follow some kind of rule. The Fed publishes the Taylor rule in their reports. They took it out, they put it in, it's now back in again. And all the central bankers, they focus on that. But there's a global aspect of that, too, which brings countries together. The fact that there's a 2% inflation target, and they're also concerned about the state of the economy, unemployment rate, is very important. And I think that what we can look forward to going forward is not have these bouts of very high inflation, 9.1%, et cetera, and get away from that. And then the global situation will be better, I believe. It's not just Europe and Japan, and there's Latin America. Latin America still has a very high inflation rate, and the way to get around that is to have a more focused goal of 2% inflation.
Yeah, and it's interesting you bring up the coordination there, because every time we have this conversation about the Fed abandoning 2%, you kind of forget this idea that there is a bit of an international agreement, at least for now, as to where that should stay. Do you think there's also agreement here when it comes to the pace and the trajectory of where things are going forward? Because let's face it, Professor, as we head into 2024, the economic conditions in the U.S. look like they're going to be markedly different than what we're seeing in Europe and maybe even what we're seeing in Asia as well.
Yeah, I think so. I think that this is a real question which Jay was asked about today, is what happens if this scenario doesn't play out? I think they're prepared more than they were before. We'll see. But I think if the economy weakens, then they lower rates faster. If the economy speeds up, they raise rates. But the main thing is to look at what the implication of their recent decisions are for other countries. And I think we're beginning to see a little bit of that. There's a lot of talk about it. I think you're going to be covering it yourself for quite a bit. But that's an important thing going forward, is where the Fed fits into the global situation.
All right, Professor Taylor, it's always wonderful to talk to you. Professor John Taylor over there at Stanford University, former advisor to two presidents, and of course, a former assistant secretary at the Treasury, helping us break down what we learned today at that Fed meeting. Coming up, we're going to dive a little bit deeper into the market reaction to it with Katerina Simonetti, Morgan Stanley Senior Vice President and Private Wealth Advisor. This is The Close on Bloomberg.
I just think that they're very happy with how the economy's performed. I mean, basically, they've had decent growth, unemployment rate's stable, and inflation's come down a lot. And that's basically, as good as it can get.
I think unlikely that rates will go back up. Likely that there will be cuts in the Fed funds rate. What I got out of the dot plots is that all of the participants now seem fairly confident that another rate increase is not going to be needed.
This is a green light for investors. This bullish sentiment can go on for a while until we get a new round of economic data.
My own view is that the Fed is going to be cutting rates in 2024. We're clearly done in terms of rate hikes. The possibility of another rate hike is really low at this point.
And that was just some of our guests reacting to the Fed decision today and Jerome Powell's performance after the fact. And let's keep the conversation going now with Katerina Simonetti. She is Morgan Stanley's Senior Vice President and Private Wealth Advisor. And Katerina, you take a look at the market reaction. The S&P 500 finishing about 1.4% higher, 2-year Treasury yields down 30 basis points. Is that reaction justified relative to what we heard from Jerome Powell today?
Well, what an exciting day in the market. And, to your point, there was really nothing unexpected about the outcome of the meeting. We all really anticipated that the rates are going to stay at the current level, but there was a clear change in tone. For the first time, you could really kind of get the sense that even though, we still heard that based on the data, they might continue to hike rates and they're going to, they're leery of the, the delayed reaction to the tightening policy, but it really the focus was on the next step, what comes next, and what conditions have to be present in order for them to start cutting rates. And that was what was different about this meeting. The tone and the feel and market immediately picked up on that, and that's what we're seeing in the reaction from the investors.
Well, I come back to that first question. That is clearly what was heard. Do you think that that's the right read, this green light, if you'll call it, this everything rally that's really taking off?
Well, at the end of the day, data is going to have to make compelling case for the rate cuts, and we're not quite there yet. And over the last couple of years, what we watched very closely is inflation. And everybody noticed how Fed is very, very strict and consistent with that 2% mark. But going forward, the data to watch is going to be perhaps instead of inflation is going to be the labor market, because there was that theme and the focus on the fact that unemployment really is not hasn't risen yet to the levels that they would want to see. And we have not seen the levels of the economic slowdown that would be expected after such aggressive tightening. So, they're going to watch and see, but perhaps a couple of rate cuts. Something that we should expect in 24.
I am curious about just kind of portfolio planning and market positioning, Katerina. I mean, we came into this year, you had benchmark rates down and kind of in the low threes. And then there was sort of this shift where everybody sort of had to sort of structure their portfolios around this idea of a 4% benchmark rate and then a 5% benchmark rate, and the idea that it would stay at 5%. And now it seems like we now have to start looking into maybe a portfolio situation where we are back down into the fours and maybe into the threes.
Well, that's correct. And over the last couple of years, we've been saying to our clients, stay defensive, stay the course. They were not out of the woods yet. And there is a little bit of a fatigue hearing this messaging because investors almost want to will the bull market into existence. But if we still are seeing the economic slowdown and rates conceptually, will probably stay at the higher levels. To your point, not at the levels where they are right now, but maybe not at that zero rate environment that we've been in over the last decade. Mm-hmm. And finally, the breadth that we're seeing in the market is really not something that we usually see in the bull market yet. So, we would like to get but we're not quite there yet.
But does that drop in yield? I mean, let's just say it does stick. I mean, even now, I mean, we go from 5 down to whatever we are, 4 on a 10-year. That's a 1 percentage point here. Does that change materially the valuations? I mean, assuming that you're using some kind of discounted cash flow model, does that change the valuation by a tremendous amount for some of these equities?
Well, there are two sides to the equation here from the investment perspective. On one side, from the equity perspective, this is where, our defensive positioning comes into play, and being in sectors such as, financials, industrials, and energy, the ones where the earnings are somewhat more resilient to the different market environment. And of course, the, some of the spending that we see in energy and infrastructure is going to be to make some of these companies more profitable, really any economic environment. The other side, of course, is to take advantage of the higher yields on the bond side, while we still can, because we've been in the environment where we enjoyed higher rates on cash for the first time in many years. And what we have to remember is that these levels, once interest rates are going to start coming down, will go down as well. So the messaging really is, we are staying defensive, but we're not telling investors to abandon their asset allocation to divest themselves in equities. They just have to be smarter, to your point, when it comes to valuations, when it comes to market positioning in terms of what they own.
So you're staying defensive or recommending investors stay defensive. What would you need to hear in order to recommend and give them the go-ahead to take on more risk in equities?
And from the risk perspective, staying defensive is not necessarily de-risking, but we can't ignore the fact that the Magnificent Seven, and specifically tech, has done so well. And this is where the healthy amount of profit taking, rebalancing, tax loss harvesting, improving, the tax efficiency of our portfolio management, all of these, would be good tools to have. And being more selective, the security selection and positioning of the portfolios, certainly makes a lot of sense, because we are optimistic. We're actually, bullish in the longer run, but we have gotten into the habit of looking only a few months out, 2 months out, 3 months out, what's going to happen in 6 months. And with portfolio positioning, it really makes sense to look a few years out. And this is where these real opportunities for growth, for the economic recovery, when Fed starts easing, we want to make sure that when next bull market comes here, that we're in position to take full advantage of it.
Yeah, perhaps we're moving a little bit closer in that direction then. Really appreciate your joining us today, Katerina Simonetti of Morgan Stanley Wealth Management, giving us some perspective here. It's really interesting, guys, to think whether this is what investors were waiting to hear, or perhaps what Powell didn't say to give them the green light to go back in.
I am curious. It's going to take a while to really figure out what's going on, but I thought the idea that the narrative of Powell sort of meeting the market to a certain extent in the middle ground, that seems to be the narrative. I'm not sure that's exactly what his thinking, but it appears to be that's what the narrative people want to spin here. And I do wonder if that's just setting up the market for disappointment in a few months' time.
Or maybe fighting the Fed. It finally worked.
You heard her here first from Katie Greifeld. Fight the Fed. Still ahead, we're going to give you some other pearls of wisdom from Katie, Scarlet, and I as we set you up for what to watch tomorrow. This is Bloomberg. All right, well, the Fed may be done for the year, but, well, guess what? The economic data isn't here. We're setting you up for what to watch tomorrow, and we start off with, yes, Scarlet, economic data.
Yeah, let's go with retail sales. Not that it makes a difference to the Fed right now, but how much people are spending, how much they're consuming, whether services continues to get a lift.
Yeah, absolutely. And those weekly jobless claims, which I know you're huge on.
Huge. Of course, we get them every week. Not a great read-through necessarily into NFP, but still some high-frequency data when it comes to that labor market, which we're going to be paying more and more attention to.
And then, of course, overseas, a lot of other central bank decisions on tap over the next 24 hours.
This is truly the last week that matters for 2023. Of course, we get the ECB and a whole bunch of other banks.
Norway, Mexico, don't forget Peru.
I could never.
I think the BOE, and there a lot of important ones coming down the wire tomorrow. So it'll be interesting to see sort of what comes next. And we have that big EU Leaders Summit. I believe, is that in Berlin, taking place here?
Brussels, maybe?
Yeah, Brussels, Berlin.
A city with a B.
I don't know. Yeah, we don't actually, research any of this, but we'll have full coverage of that. And also, Vladimir Putin scheduled to give that big annual media conference, which I feel like those just go on and on and on for hours.
I feel like he's always holding a media conference in one way or another.
Well, if you want to tune in, that is happening at about 4 a.m. New York time. Definitely something to keep an eye on.
But should we just say it again? There's still earnings?
There's still earnings out. Guess what? We're getting a couple tomorrow. Costco and Lennar.
Costco, by the way, the late Charlie Munger's favorite store.
There you go.
Absolutely. Really appreciate you tuning in with us today here. We'll be back tomorrow. Stick around, though. Balance of Power is coming up next right here on Bloomberg.